The Mass Budget and Policy Center has come out with some new ideas for generating state revenue and redistributing the tax burden. To tell us what they have in mind are the report's authors and the center's senior policy analysts, Wise and Phineas Baxandall. Thank you very much for being with us.
Thank you.
I want to start with Phineas. Before we get into redistributing the burden and getting more revenue, why would we need more revenue right now in this state?
Well, different people have different ideas about whether we do or we don't, but we kind of step back and think about what revenue is that revenue is really the resources for what we as a Commonwealth do together, what we accomplish, whether it's education or having good roads or clean air, any of those things that we want to accomplish together. In the Commonwealth, we're going to be doing it through those resources, through those revenue. And there's been, over the long term, these very deep tax cuts, which are kind of catching up to us, and which is why you constantly hear about budget shortfalls and why we're not able to pay for some of the things like education or to fix our 500 structurally deficient bridges or what these things are. So if we want to decide to prioritize those things, we do need the resources, and that would mean revenue.
Kurt, 35 years ago, our state was known as Taxachusetts. It's been tough to live that down, but what are the real numbers around that?
Yeah, so clearly that was the case 3 or 4 decades ago. Massachusetts has, both at the state level and at the local level, made a lot of tax cuts in the intervening years. And as a result, we now are a very middle of the road state when compared to other states in terms of total tax collections at the state and local level as a share of the economy. So we're a very middle of the road state in terms of tax levels. We definitely do not deserve the title Taxachusetts any longer. And a lot of that, those tax cuts are sort of adding to some of the issues that Phineas was highlighting in terms of need for revenue potentially if we're going to address some of these big issues for the state.
Phineas, as it is now, most of this revenue comes from the state income tax, which has the same rate, whether you're rich, poor, or in the middle. But what about the taxpayers themselves? I mean, over the past few decades, what has happened with, I guess, their ability to pay?
Well, over the past few decades, for middle and lower income people, their incomes have really barely risen at all. For those in the top 1% of the income ladder, their incomes have grown really briskly. And so they have sort of where the money has gone is towards their income growth. And that affects what kind of revenue can generate if you're drawing it from kind of middle income, lower income people, you're taxing a kind of stagnant pool. And if you're not catching those highest incomes, you're missing out on a lot of that revenue.
And Kurt, if you look at this as a percentage of total income, what people are paying in the state, is that uniform or is it different according to whether you're poor or rich?
Yeah, so I mean, it varies significantly depending on where you are in the income distribution, whether you're poor or whether you're rich. Folks at the low end of the income distribution, the bottom 20% or so, contribute.
Yeah, for them, it's just, I just did a paper on this. It's for the bottom 20%, they spend 10% of their income on state local taxes, and then it kind of diminishes so that the top 1% actually only spend 6.8% of their income. So it's what sometimes gets described of as a kind of upside down tax system. Instead of those with the greatest means paying the biggest share of their income, they're actually paying the smallest share of their income.
Right. And get into a little more detail on this because there are different rates for different kinds of income, and that explains it. So how does that work exactly in Massachusetts?
So we have a flat rate for wage and salary income in Massachusetts. Right now it's 5.05%. There are other kinds of income which could be taxed at different rates. Unearned, various kinds of unearned income, capital gains income, dividend and interest income. Those are taxed at the same rate currently, but that isn't necessarily the way it has to be. That's a decision that could be made differently. There are corporate taxes, those kinds of income, that kind of income is taxed at a different rate. So yeah, there are a variety of ways that the state raises revenue, and it's, those are mechanisms we can explore for changing how much revenue we generate in the state.
This is BNN News, and we're talking with Kurt Wise and Phineas Baxandall from the Mass Budget and Policy Center. Phineas, obviously, I'm not surprised here. You want these taxes to be more progressive overall. So how would you have that done?
So we've noticed that over time the taxes have gotten some of the more progressive taxes, those that tax more from the highest income people, those rates have gone down, like the income tax has gone down over time, while things like the sales tax have gone up over time. So one thing is you can sort of reverse some of that, but then we in this paper that we did recently list 14 different options for things, sort of more creative ways that some of them other states are doing. The City of Portland just came out with something where they're newly taxing CEOs whose companies, CEOs who make more than 100 times what their average employee make, have a certain surtax on. And each of these different things listed in our paper has different advantages, different kinds of potential for how much revenue it can generate and how much it would tend to hit those at the very top.
Yeah. Kurt, what about the taxes on investment income? Because I have a feeling that yes, it was a way of catering to rich and influential people, but these are also incentives to support the economy too, aren't they?
Meaning lower tax rates?
Some of those lower tax rates for the unearned income.
So I'm sure that's an argument that's often made. There's a lot of evidence to suggest that when you raise tax rates on folks with very high incomes, that the end result is that those folks really are not leaving the state in any significant numbers. So, I think that's the argument that's often made, that it somehow incentivizes people to come, to remain in the state, to invest, but there's a lot of the best research suggests that it's really more of simply a revenue loss rather than an incentive that drives new economic investment or growth.
Phineas, what about inherited wealth in this state? Should we tax that differently?
Well, a lot of economists point to a particular law that we have, which is a very kind of odd thing. If somebody dies and they sold, before they died, they sold their stock and then gave it to you, it would be you would pay on the full value of how much that stock had increased. If they gave it to you as a gift, they would also pay the full value of it. But if they died and then you sold it, you would pay only the amount that it increased after that person died. This is called stepped up basis, and the governor estimates that us having this rule, following the federal government in this rule, costs the state $842 million a year having this rule. So you can think of it as a kind of special subsidy that we have for inherited wealth, having that rule.
And most of the people who benefit that are very wealthy. We're not just talking about average people getting something from their aunt or something like that.
Yeah, that might happen to a tiny bit, but here it's the vast majority. Who gives inherited wealth and who has things which are having capital gains? Most of that is financial assets, stocks, bonds, things of that sort. And these rules actually don't apply. Most people, middle class people or lower income people, if they have wealth, it might be their car or their home, and there's exemptions from that kind of wealth from being taxed this way. So really the things that would be taxed this way and aren't, that are getting this special subsidy, really are almost only benefiting the very top.
Kurt, taxing investment income more heavily can help make things more progressive, but we're reading just lately that if you look at the state revenue for the past month or so, that income from the capital gains tax, it's more unstable than the other kinds of revenue streams. So isn't that something you got to worry about?
It's certainly something you have to factor into your thinking about how you design the overall tax system, but that's not a reason to leave it untaxed. It's a very progressive potential source of revenue, and there are ways of dealing with it. The state already has in place a mechanism for setting aside capital gains revenues above a certain threshold each year and putting that into the stabilization fund, so that less than around $1 billion a year in capital gains revenue that goes towards operating budget each year. If it's more than that comes in capital gains tax revenue, it goes to the stabilization fund. So you can sort of smooth out some of those blips that come with various revenue streams, but that's not a reason to sort of set them aside and say they're a no-go area.
Thank you both very much. Kurt Wise and Phineas Baxandall from the Mass Budget and Policy Center.